Hello YouTube. Today we're going to be picking up where we left off last weekend when we were wondering whether or not the bear market of 2022 is still tracking the bear market of 2020. And it looks like now we are due for some relief. After 7 back-to-back red weeks, we're now finally getting a bounce on the SP 500 and on most major indexes. Today's going to be a very exciting video. I encourage you to watch all the way through to the end because there's going to be a lot of data, and we're going to provide you with a roadmap for how to get prepared for the summer trading that is coming ahead. All right, so let's jump in and just see what we actually did this week versus 2008. So we can note here that initially we did reject off the 50 MA. We can note here that same thing happened over here in 2022, which means that our bear falling wedge is actually pretty valid. We note the same thing happening over here in 2020. I'm now going to remove the current trend lines and then actually delete the up arrows because now we can clearly see that once we got down to the bottom of the funnel here, we did have a nice snapback. And we know that happening right here on the S&P 500. So this is a very, very good sign. The question is this enough? Is it truly a reversal or is this a dead cat bounce? Because ultimately what I was guesstimating what happened is that we get a nice dead cat bounce, which lasts potentially for 2 months, which is almost perfectly aligned with where the Fed is going to be telling us whether or not they're going to continue raising rates after their July meeting or whether they won't. So if we are still in a bear market, we are going to dive lower. However, history repeats itself. History does not repeat itself, but it rhymes. And at a certain point, if we can just continue to go higher, that is really what we're looking for. So the key warning sign for me, if we now zoom into 2008, as I mentioned last weekend, was when we note here that, again, we start staging higher lows and higher highs, and then we don't. So we were going down, we were going up, and then we start going sideways again, and then the inevitable drop happens. So right now, I believe we're in this period about right here where we're staging an up move, and this is going to be very interesting because once we keep going up, it means that it's going to be easier to go. The warning sign here is that the volume is quite low, and then once we start printing those lower lows and lower highs, that was actually the warning for the next leg lower. And I want to focus in on this one part right here because what we talked about last weekend was that there's a bullish pattern that we can actually rely on. And that bullish pattern comes in here from a falling wedge. So the falling wedge pattern pretty much tells us that, again, let's just have a quick look here and see what it means. It means that we're going to be staging an inverse head and shoulders again. This is a textbook pattern. It does not mean we're going to repeat it exactly, but it means that if something similar sets up, we want to kind of believe it. And now we note that we're looking at this part right here where it tells us that buy a retest of former resistance acting as support. So now what we have to be prepared for is whether or not we actually go up this week. Because right now, again, I got the NASDAQ here on the left-hand side and I got the S&P on the right-hand side. Well, we can actually go back to the 2008 example because when we look right here, that is the classic backtest of the breakout. So it breaks out, it backtests, and then it advances higher. So the reason why that's important is just because when we look here to the NASDAQ and to the S&P right now, the S&P has actually reclaimed that neckline for the inverse head and shoulders. We find that here at roughly 410 on SPY. And over here on the NASDAQ, we note that it's at about 13,000, which means the NASDAQ still has to actually shoot higher so it can ultimately land on that right shoulder. So we're getting a lot of really positive signs. And I now want to shift gears here to just actually talk about what actually happened this week because it was a broad-based rally with almost everything going higher. So here we can note that we got a big rebound with the S&P staging its best week since 2020 after a long string of weekly losses. Nice. Kudos, bulls. We can also note here that we are rising in sync. Major financial assets post unanimous weekly gains for the first time this year. That's right. The first time in 2020, we see unanimous rallying, right? The market is synced up. So when we were talking about an orderly decline, now the question is, are we getting an orderly advance? And I will circle back and talk about that a little bit later. Finally, pairing bearish bets. Short interest in the S&P 500 is subsiding as the gauge rebounds. So the reason why this is so important is because it's telling us that this is the start of a short covering rally, but if the bulls come in and start buying fresh, that is how a dead cat bounce can actually lead to a reversal. What am I talking about? I'm talking about how this is a bear covering rally or a bear bounce, right? Bear market bounce, whatever you want to call it. For us to get a true reversal, we have to first of all take out the relative low, but then we have to also take out the relative high. So for the NASDAQ, that means going dramatically higher. It basically means we have to get back above our 50 weekly moving average. We have that same thing over here on the S&P 500. This level becomes particularly important as we look here to our next segment, which is going to be, again, whether or not the S&P is still tracking 2008. And that's the reason why I'm using it as my template. We can note here that the red line shows where we currently are. This is now about a week old. So it shows us here that we were, again, at about 96 trading days in our current downtrend. And we can note that if we keep this current trajectory, it means that we are repeating 2007 and 2008. And that is a little bit scary because it means that we're ultimately going to be going down by roughly 50%. And right now, when we look here to the broader market, we're only down by about 20%. We have not even officially closed in correction territory. So this move over here in 2008 gets a lot worse when we actually look forward in time to where we are here. Again, that's where we have to ask ourselves, is this complacency? Is this something different? Because, oh boy, that's when it really starts to get nasty here. So again, I hope that we are putting in a bear market bounce, which could lead to a bigger move, but I don't want to be blindly bullish either. So now what we're going to do is we're going to think about, again, if we are going to get that backtest, where do we actually get invalidated? And do we have time to actually repeat the pattern? And if so, what should we be specifically looking for? So right now, I'm going to follow up on what we also looked at last week, which is the SPY psychology chart. So over here on the right-hand side, we have the psychology of a stock market cycle. And it shows us here that at the time, we were looking for, we were looking for a bounce here off of the pink line and the green circle that I have here, basically looking for a short-term bottom. So now let's look at the S&P and see if it's managed to bounce, because it did. So now let's look over here and we'll go to SPY. We'll go to a 1 month chart and we'll make this full board. So we can now note that, whoa, those bulls took us back to green on the month. And now the pattern looks a lot more similar. So when we look over to here, I think what I'll actually do is I'll go like, actually, I'll just leave it. I think you guys can understand what I'm trying to point out here. So what we can note is that we're looking for the bounce here, which happened. We're now back above the pink line. So that means that we now have a clear area of support. And if the pattern's going to repeat, this right here pretty much tells us that we should be bouncing back up to where? To roughly the red line. And the red line for us is 454. So as we look now to a side-by-side board for the S&P, we can now note that, actually, how am I going to do this? So let's actually go all the way in time here to where we are now. And let's look and see what it's currently doing, because I think it's really important for us to understand this. I think I already have it here. Okay, great. I already had it here. So sorry for bouncing around a little bit, but what I want to show now is that if we are going to bounce, where can we ultimately land? So when we look here at the S&P, I already have this red line drawn right here. So the red line, the line drawn right here pretty much signifies a 10% off the high, but the level I'm looking at here is going to be this area right here. This area right here is going to be our head and shoulders neckline at 454. So if we are going to bounce, the upside potential, keyword being potential, would be for us to get all the way back up to here. Again, this is if we perfectly match the psychology chart. We should be able to dead cat bounce all the way back up and retest that area. So the question is, can we? Because going back to 2008, and sorry for having to go back and forth here a little bit. I just, right, I'm a human. I'm not perfect. If we look here, this dead cat bounce was very weak. So when we came back down to here, we did not dead cat bounce back up to test that neckline here on SPY, which means that just because we're looking for the potential to max out at about 454 does not mean we're going to hit it. We might actually stall out a little bit sooner. So again, very, very, very positive sign. Now the question is, again, the last calendar day of the month is going to be Tuesday, and then we're going to be closing out the weekly candle after. So that could lead to us rallying to close the month out higher, and then ultimately come back down to retest this area right here. I'm talking about the downtrend. So now we're going to do a little bit more analysis on SPY, and then we're going to move forward. So if you're enjoying the stream or the video, I would really appreciate a thumbs up and drop me a comment. Do you believe we are starting a new secular bull market, or is this just a dead cat bounce and the bear market is prevailing? All right, so now we're going to look at a few more things here, because I think it's really important for us to understand where we came from versus where we're going. And now what we're going to look at is going to be a very important critical area, because last week what we were talking about was the volume profile in terms of us being in no man's land. And no man's land pretty much means that we have one pocket of volume here, and otherwise we're looking for supply to come in the 420s and demand to come in the 330s. So what I want to focus on right now is just an excerpt that we actually had from last weekend's video. And this right here pretty much tells us that, again, he also said that since January 2021, the average entry point for $1.1 trillion of inflows was 42.74 on the S&P. Again, the investors are underwater, but only somewhat. So what this means is that as we start getting closer to this, the supply pocket, meaning where people have shares they want to sell, the question is, can we actually chew through it? Because again, we're getting quantitative tightening starting on the 1st, which is going to be Wednesday. And if we're already in a low liquidity rally, how are we going to chew through this $1.1 trillion in demand? That is going to be a lot. And that is pretty much where this first level of supply comes from. If we stall out there, that might just be the top like we did in 2008. If we can chew through this one here, there is a whole bunch more supply for us to get to. And it stops at roughly 454. That is really where it peaks out. So that is where I get the potential for an upside target on the S&P to get all the way there. Final thing I'll point out here in regards to the S&P is just that before we're going to get bullish on the daily and weekly and monthly charts, we have to remember that it starts on the lowest time frame. So for us, that's going to be the hourly chart. And what I'm looking at here is that we are starting to see some really, really positive signs. And what I mean by really, really positive signs is that, first of all, we stopped going down, which we can see here from our blue descending triangle. Falling, right? It's just a channel. So falling channel. And then we have a pink pennant, which showed us that we're trying to actually break bullish. And then we did. We got above the 50 MA. We backtest and pass, meaning we backtest this pink wedge, which is right here. We get above, we form a new uptrend, and now we're rocking that. And we're way above the 50 MA now. We're finally getting some volume here, although there is still some red, which means it's a reluctant rally, not an enthusiastic buying spree. And now we can note that if we're going to get a fresh push, we're going to find out by Tuesday at noon. So after the market goes into the end of the month, if we are above 416, it means that we're probably looking for an advance of the 420s. So for us to continue higher, we now see that the hourly chart is now starting to show some really bullish signs. And now we look here at the daily chart. So we stopped going down because we broke the downtrend. We're forming a short-term uptrend by having this line right here. And the question is going to be, when we get to this 420 area, which lands on Tuesday the 7th, are we going to be above or below it? This 50 DMA is likely going to curl down to meet us in the low 420s. And if we can claim that 50 DMA, again, let's look back to the hourly chart and see what happened. Here's the 50 MA at 400. Here we are, only a couple days later at 415. That's a dramatic move. That is how we get higher on those time frames. And that is what's going to feed through to this weekly chart getting up to its 50 DMA at 431.98. And that 431.98 is very important because that is 10% off the high. So if we're going to end the bear market and begin a new bull market, we have to get out of correction territory. We have to get above 432. And that is how we have potential to get to that 454 area. All right, so I actually got through a lot of stuff pretty fast there, and I wasn't sure I was going to be able to do it so great. So now let's move forward to some options, because now that we understand how the stage is set, we want to know, are these bulls showing up to give us any motivation to advance higher? And as I look here to the chain for May 31st, which will be the last calendar day of the month, I'm noticing that there's finally some bull activity. We notice bull activity at 410, 415, and 420. These are call spreads. So this is notable because if we're thinking that we can go to 420, I'm seeing some motivation here. Finally, for the first time in a couple of weeks, we're finally seeing some calls bought. However, there is still a whole bunch of puts here for Monday, notably 100,000 in volume sitting here at 410. They did get completely smoked, but we'll see whether or not they try to salvage them and try to get them in the money. Looking forward to Wednesday. It's pretty much even, although I am trying to show here that, again, there is volume on the put side. I'm just trying to show that 410, 415, and 420 area has continuation. It's also notable that 412 is also getting activity. Why? That is where we are flat on the month. So as we look back here to SPY, we look here at our monthly chart, we note that, oh, that's right, 412.00 is the April low. That's really, really, really important. One more thing before I forget is just going to be looking at the quarterly chart for the S&P 500, because that 410 becomes increasingly important as we zoom out to higher time frames. As we look here, again, the Q1 or the first quarter low is 410.64. If you need time for me to show you all the levels, just stay tuned. In a couple of minutes, I will show you all of the levels that are going to matter for this week, including resistance and support. So now moving forward to Friday, what do we have? Look at these bulls. These bulls are flexing. Yeah. We can note again, what? 412, so we got 415, 412, 415, and 420 call spreads. So what does this mean? It means they want us to continue higher, not just through to Tuesday or Wednesday, but through to Friday. Yeah. And now as we look forward to the June monthly chain, again, there is dramatic puts in terms of open interest, but what I'm noticing is continuation. And again, we have about 30,000 in open interest at 410, 415, and 420. And then we got 30,000 in volume at 420 for the June 17th monthly expiry, which means that there's continuation all the way through to June 17th, which is about 21 days off, or about 3 weeks. And then finally, looking through all of our top option plays, I noticed an index. Again, top 25 indices. What I noticed is that there was a $135 million bull bet placed for December 16th. And this is for 3950 SPY. Again, they bought 4,500 options for $319, which equals $135 million. It was the only notable order to me. And that is notable on its own because it means that this is a reluctant rally where people are reluctant to really bet big bull. But once the wheels are in motion, and again, we're up by nearly 6.6%. So the devil is in the details. And again, using that word intentionally, 6.6. And that is going to give us a clue. All right, so now we've talked about options. And the next thing I want to look at here is going to be some of my prepared notes. And then we're going to come back through and have a look at a few more things. So what we have to remember is that we are in a bear market until proven otherwise. That is my base case. And I know exactly what levels I want to see taken out for us to actually confirm we're out of the bear market and in the potential for a new bull market. So moving forward, what are we looking at here? Again, 2008 repeat. Is it time to bounce? I showed you the reasons why, and hopefully now you understand that. So again, if it's time to bounce, we want to make sure we're getting breadth, we're getting depth, and we are seeing sentiment shift, which we are. Actually, I think this might be a good time for me to, let me just think here. So we talked about the 2008 repeat. We talked about time to bounce. All right, orderly advance. So I think what I'm going to do is I'm actually just going to skip this part for now because what I actually want to go through is just showing, I'm going to wait. I'm actually going to wait. So I'm trying something new this week. So orderly advance, I'm going to come back through. I'm going to talk about what an orderly advance would mean. And we already touched on that, meaning that we are seeing all the indexes rise for the first time in 2020 unanimously. So that would call that an orderly advance. And what we're missing, though, is that QQQ was not quite outperforming SPY. And we noted that on the falling wedge pattern, which is where it did not quite advance. So when we go to the chart review a little bit later in the show, we'll look at the charts that matter and whether or not the leaders of yesterday are still the leaders of tomorrow. Volume drop-off, demand and supply pockets. We talked about it. So I think that in a low liquidity environment, the moves can be over-dramatic down and they can also be over-dramatic up, which is exactly what we saw this week. A 6% rally on an index is huge. Finally, we're going to look here at, again, so what I think is going to be really important here is while equities have slumped, paralysis rather than panic best describes investor positioning. And that really feeds through to that psychology chart I showed you before in terms of complacency. Complacency means we have to cool off just before the next big rally. And when I read this quote here, that's exactly what I am getting as a takeaway. Bear market targets. So I think that we have now hit down deep enough inside of the bear market territory that we're getting a bounce. If it's going to lead to a reversal, I've already told you what I want to see. And we know the levels. So the Powell put was roughly 380, but it was actually the stock market put. And it was the bear covering area. Why? Again, when you make 20% on a short, you cover, you get out, you at least trim. And where are they going to reposition? I told you the levels. What's really important about the current bounce as well is that even though the index, meaning SPY, only went down by about 20%, a lot of individual stocks went down by 50, 75, and 90%, right? Snapchat's down by 80+%. A lot of the ARK fund is down that much, and that is why some people are dipping their toes in, myself included. I've made a couple of strategic investments this week with stop losses, and I'm looking to add more next week. Why? I'm looking at the numbers, and if we're going to lead to a dead cat bounce fail, it means we're going to stop out. That's okay. But if we're truly starting a new bull market, do you really want to be on the sidelines? Do you really want to miss out on potentially hundreds of percent of gains? I don't. All right. So with all that said, what are the levels we have to specifically be paying attention to? And again, here we can note that we're currently still in a bear market. That's my current opinion. 412 gets us to green in the month, which we currently are. Over 428 gets us back to kangaroo, which means that we're getting choppy direction. We don't know if we're going up or down. And that 428 pretty much comes from our quarterly chart here, where we can note that when we smooth the data out to being one candle for every 3 months, we note that this 428 to 430 area is really important. It's a quarterly high going to the summer of 2021. And it's where we closed out the Q2. It's where we started Q4. And it's pretty much where we've been having a lot of trouble. So getting back above there means that we've sucked up, we've had a chance to sell, and we chose not to. So that also leads to our apex right here. And if we can't get above 430, I don't see us going back up to 454 or higher. And we know that January, February, March is the first quarter. Well, January, February, March, April, May, June. So we're going into the final month of this quarter. So if we can't get above 430, what does that mean? Well, that's going to be a bear break. That would mean that this uptrend or this ascending triangle is actually going to break bearish. And that would lead to our 2008. All right, then 432, we exit correction territory and we have the potential for a bull market. So again, going back to our chart here, that is where we are now going to be exiting that negative 10% off the high. And that just means it's getting back above 432, which is also what? A very important area. Very important area. And then inside of support, so we can note here that the numbers are pretty much round. So the first level of support should be found at 415, which is going to be our March low. 412 is going to be the April low. And then 410 is going to be the Q1 low. So what I'm pretty much looking at here are very high time frame charts, meaning we're looking at monthly levels. We're not looking at daily or weeklies, we're looking at monthlies. And then finally, inside resistance, we got 420, which are those options I just told you about. 425 would be a nice round number and a psychological area. And then 428 would be that quarterly base where we get where? Back to kangaroo with the potential to exit bear market and go into a bull. What are the key dates we have to be aware for this week? Well, it's going to be an important one. And happy Memorial Day to all Americans. I hope you have a chance to enjoy the long weekend. The market is going to be closed on Monday. On Tuesday, we have the close of the month. That's going to be very important as to whether or not we are above or below that 412 area. Why? The next day, on Wednesday the 1st, first start of June, or the opening of the month is going to be where quantitative tightening begins. So we're now going to see that balance sheet runoff, and that's going to really matter. Closing the week hit, we have Friday and payroll Friday, which means we're going to be looking at the unemployment rate. We're going to be looking at payroll numbers, and that's coming out on Friday. It is always the first Friday of every month. Finally, we've got the Amazon split happening on Friday as well. What I'll be looking for is going to be sentiment and whether or not the split signals a short-term top, because Amazon has been on a huge decline and it's actually due for a snapback. So also touching on the quantitative tightening, we got some Fed speakers this week. We got speakers on Monday, Wednesday, and Thursday. So on Monday, we got Waller. On Wednesday, which is where I will be focusing my attention, we've got Williams and we got Bullard. And then on Thursday, we got Mester. So the reason why I'll be focusing on Williams and Bullard is because Williams is a dove, Bullard is a hawk. And Williams is in the troika, which means that he is one of the three most important people at the Fed with Jerome Powell, Lael Brainerd, and then Williams. So they are the three most important people at the Fed. They are the troika or the leading steering committee for the FOMC. And then James Bullard is the dog, pretty much out there yapping all the time. And I'm really paying attention to what Bullard says, because right now, part of the reason for the relief this week was that people believe the Fed has optionality to stop rate hikes after July. And that is probably baked into a lot of people's assumptions. Mester George is likely, I think it's Mester George, I forget. She's going to be rounding up the week on Thursday, and she provides a little bit more of a balanced view, but she's definitely leaning hawkish. So the reason why this is so important is because as we're going into even more quantitative tightening or reverse liquidity, we've now hit a record of $2 trillion in reverse repo in a single day. That means that we're getting a lot of liquidity removed from the system. Again, remembering that those inflows that we saw year to date were about 1.1 trillion. So all the money that flowed into the market in 4 or 5 months now, we took that out times 2 in a single day. One more time. All the money that flowed in so far this year. And again, let's look back to that quote that I had here. So let me go back in the PowerPoint, because here it's telling us that, he also said that blah, blah, blah. The average entry point for 1.1 trillion of inflows to the S&P. Again, 1.1 trillion in inflows. And what did we just talk about? We just talked about having $2 trillion in liquidity removed. So that's a lot. This is also very important because we're seeing some economic data from the CBO, or the Congressional Budget Office, telling us that maybe we did hit peak inflation. So they're telling us here that, and again, with I've gone through and did a little bit more parsing of the data, and it tells us that we have to take this with a grain of salt because they prepared these numbers a couple of months ago, because these are used for budgets. They're also used for the Department of Defense when they have to know how much inflation is, so they know how much to increase the budget by. So these numbers are a few months old, and as we know, the last few months have been very shaky, where more uncertainty has definitely creeped into the market. So these numbers are likely a little bit too optimistic. However, this is what the market is assuming, and why we're moving higher. So we have to really pay attention to what those Fed speakers are going to say. And if we're not fighting the Fed and they tell us that peak inflation is now potentially here, maybe we can continue higher. So here they're telling us that into 2022, we're going to see inflation at 4.7, down to 2.7 in 2023, and then 2.3 in 2024. So if we get to that neutral rate, which we talked about last weekend at about 2.4, the Fed could justify stalling out or not raising rates more if this is also their projections. They're also saying that GDP growth is going to be expanding in 22, 23, and 24, which means no recession. And unemployment is actually going to move down. Move down, move up, because we're at about 3.5 right now in 2022. It's going to move up to 4.2, back down to 3.6, and then up a little bit into 2024. However, remembering that anything below 5% is technically considered full employment. So this is exactly what Jerome Powell wants to happen. This is the soft landing scenario. And then the 10-year yield would be at 2.4% for this year. Right now, we're about 10% higher at 2.7, 2.9 for 2023, and then 3.1 for 2024. So what I want to do now is actually shift gears to a little bit more data, because we have some more context in terms of what this all means. So this data came out on Friday. The PCE, again, the Fed's favorite inflation measure, rose 4.9% in April, and a sign that price increases could be slowing. Keyword they bring could. So are we pausing on inflation, or are we peaking? That's the big question. And again, if you haven't already, I would appreciate a thumbs up and drop me a comment. Do you think that we are peaking on inflation, or are we pausing on inflation? Finally, looking to that CBO forecast, which we just reviewed, and the numbers that we saw, the CBO boosts U.S. GDP growth estimates, says inflation has topped and will cool to 2% by 2024. This is exactly what Jerome Powell wants. All right, now let's hear from someone who is not working at the Fed and someone who is in the know. I've been watching Larry Summers for a number of years, and I respect him. I trust his opinion. And frankly, he does not really have any political motivation to lie. Why? He's not in office. He is the former Treasury chief. So he is where Janet Yellen is now. He is the former Treasury Secretary. Fed at last adopted appropriate policy posture. And what does this mean? Optionality. So Summer blasts the CBO budget office for inflation calls. So that's what I pretty much talked about before. And this is coming from a professional, right? This guy is much smarter than I am, and we have to listen to him. So here we go, right? I thought the Fed's posture at last was broadly appropriate. Now the question is going to involve carrying through. So that's the big question here. And I'm not going to go through and read the article, but what he also talks about is that he still thinks that a soft landing is possible, but not probable. What does that mean? It is possible we have a soft landing, but he thinks that it's not likely. So that is very important for us, because this guy was there in 2000. He was there in 2008. And he was in office in 2000. So he's old enough and smart enough to know what was happening in 2000, know what was happening in 2008, and he's saying that there's still some problems here. So I'm listening to and I'm paying attention. All right, so with all that said, why are we bullish or why are we bearish this week? Well, value compression. There's something else that I want to bring up, but to keep the video a little bit shorter, the NASDAQ is now back at valuations that go back to 2019, which means pre-lockdown. So stocks are cheap, notably the NASDAQ, which had a really nice snapback this week. So value compression, is it enough? That's the bull case. That's the only one too. In terms of the bears, we got 454 impenetrable fortress, which is going to be that head and shoulders neckline we just talked about, and where we would expect to have the max out on the seasonality chart, the psychology chart we showed for the SPY, that red line we were talking about. And again, I'll just show it one more time here to make sure everyone knows what we're talking about. It's this red line right here at 454. So we got our shoulder, we got our head, and we got our shoulder. Until we get back above 454, this head and shoulders pattern is valid. DXY and TNX breakouts. As we go to the chart review a little bit later, DXY is coming off and TNX is also coming off. So these are really positive signs, but I think it's a little bit too early to call a top. Recession risk. Again, per the CBO, they're saying there is no recession risk. But when we saw those GDP revisions this week, they went from negative 1.3 to negative 1.5, which means there was actually more contraction or a higher risk of recession, even though the market went higher. That's why it was important that we went higher this week, because people are thinking that maybe the Fed is going to have to pause. Maybe things aren't as rosy as we thought. And then tech leading the decline. Absolutely. So there is potential for that IHS pattern on the NASDAQ and on SPY, but the NASDAQ has not yet confirmed it. All right, in terms of surprise as well, we got quantitative tightening starting on the 1st. That is going to be very important. Why? This is the equivalent of interest rates rising. It's tightening of monetary policy. Then we got the Fed, right? We got Fed speakers this week. I'll just be watching to see whether or not we see a notable change in tone from Williams and from Bullard, because that's going to provide the dove point of view and the hawk point of view. And then Russia. Again, I hope something happens there, but doesn't really seem like it's all that likely right now. That's why it's a surprise. All right, now let's talk about our base case. Well, our base case is that TINA for stocks, it looks like there might even be TINA back, because China's saying that they're actually worse off today than they were in 2018. So that's actually really bad. Why? Well, if Walmart and Target are having a hard time selling stuff, who is the sweatshop of the world who produces cheap stuff? Which is what? That is Target and Walmart on steroids, meaning China is the Walmart of the world. So if Walmart is seeing problems and Target is seeing problems, does it not make sense that China is seeing problems? Who sells stuff to the whole world, cheap stuff? Yes. And that is why they started actually turning the taps back on and providing accommodation. 454 SPY pivot, that ended up being a bear pivot in the bears of one for now. Bear market 2022 is confirmed until it isn't. All right, so now I'm going to finish off here by looking at the bull and bear case, and then we're going to go through and look at some charts, and that's going to be the end of the video. All right, bulls. So what do the bulls got? Well, we talked about it. We got the potential for a falling wedge bull breakout, where first of all, we have to break out, which we did. And then if we're going to backtest, I showed you the example going back to 2008, how we could do that. And there's also data that aligns with here too. There's one more thing I want to point out that I think I probably forgot to say, and that is the FOMC meeting calendar. So if we're looking at where we're likely going to be getting a potential move, we have to look here to the FOMC's 2022 meeting calendar. And right here we have what? We have June 14, 15, which is going to be where? In 2 weeks from now. 2 weeks. So again, we're currently about right here. That's 1 week. That's 2 weeks. And then that could be the reverse higher. So what's also important is that, so again, the timing lines up perfectly here. The other reason why I find this really interesting is because there's an asterisk. So the asterisk means that there's going to be it's a meeting associated with a summary of economic projections. What this means for me is that the Fed is going to be giving us a guide to the future. And if they say that actually 50 basis points in June and July is not enough, we have to continue higher, then the market's going to have to reprice it. But, excuse me, if they say that June and July 50-50, and then we're going to pause because we want optionality, then that could be the relief we're all looking for. And I encourage you to watch last weekend's video where I walked you through how we actually get to that neutral rate. And I think I'm actually going to take one quick second here to actually try to find it, because I think this might be very interesting for people who might not want to or don't have time to go back and watch last week's video. So what I'm going to show here is just what I had prepared from last weekend, and hopefully you appreciate this. All right, so on the fly, right? McFly, here we go. Fed sees balance sheet falling off by 2.5 trillion by mid-2022. And here we note that that's pretty much just talking about the equity market, or SPY, the yellow line, is getting well ahead of the white line, which is the Fed's balance sheet. So we can just note that the market is due for a drop here. And then as we were going into quantitative easing or printing money, we pretty much match what we did in 2008 into 2020 here, which is why I'm also using that as my template. Huge expansion or Nike swoosh in printing, we start to base out and they start to reduce. Same thing here. So now we actually get those numbers here. They're planning on tightening twice as fast as they did in 2018. And then finally, what this means in terms of where neutral rate is, right? What's neutral? Well, we're told here that the neutral rate from the Fed is about 2.4%. So that's what Powell and other Fed officials have said in recent weeks. So 2.4%. And they've said they want to get to neutral expeditiously. By when? By the end of the year. So that pretty much means that we can't afford not to hike at every meeting. If we want to get to 250, which is 2.5%, or right around that 2.4 I just showed you, it means that we have to raise it every single meeting. Right now, we're sitting here at about 75 basis points. In June, we raised by 50. In July, we raised by 50. And then we have to also raise by 25 in September, November, and December to get to that 250 area. So that's what's really, really, really important. What are we going to hear from the speakers this week? And is there going to be any change in tone that they are saying we need to pay attention to? So again, this week we got relief. I'm not trying to give you a reason to be scared. I'm just saying that we have to be mindful of the risk. All right, moving forward. So now we note that there's the IWM and ARK bounces. So we'll look at that in a moment. And I want you to pay attention to these because it was part of what we were looking at for the, the nastiest cuts are usually going to lead to the sharpest reversals. And then the bear case, right? We've been talking about this extensively. It's not going to spend too much time here. Bear market targets, right? Largely hit. We got down to 380. There's still tons of downside potential down to 330. Next year is that we've not truly seen capitulation in the market. Why? There's not enough stocks that have dropped below their 200 DMA. There's definitely a lot more of them that are there now, but in 2018 and 2020, we saw more than 90%, more than 85, 90% of stocks that went below their 200 DMA. We're not there yet. We can also note that, again, the case for a rolling bear market is that we have a nasty cut, we get a dead cat bounce, another nasty cut, and we get a dead cat bounce, which means that we're still going lower, but it's not going to be a straight line. Next thing is going to be the Fed rhetoric, as we just talked about. So if they are truly still hawkish, we should not see them waver this week. Jerome said he needs to see data that is continuously showing that there's a cooling in inflation. One data point is not enough for this man. We're going to have to see multiple data points. So if now they start to shift their rhetoric, we have to pay attention to that. We already talked about this. We talked about the potential for a recession-like behavior. Not going to spend too much time on it. Talked about that last week. Also talked about the liquidity. And again, if we're looking for, just to get our money back, we're not going to get above 428. That is where the $1.1 trillion is have their average price for the inflows. And then finally, if we are going back to 2008, again, we have the bear case here where, again, we've expanded for 150 months, rallied by 600%, and then we go down by 50%. And that's what we've done so far. Since 2008, we've gone up by 600%, 150 months, and we're due for a correction if that is where we are ultimately headed. All right, now let's wrap this up and have a look at a couple of charts, and then it is time to sign off and enjoy the long weekend. Fear! Oh my God, we're almost out of extreme fear. So we went from single digits last week to only being here at 21. If we get above 25, we're exiting extreme fear, and that is where people might start adding more risk back on. So watching very closely to see if we can get above 25 here. And then looking here at the heat map, what's really interesting is when we look here at a 1 week performance that we have breadth, we have depth. And that's what we looked at the first slide on the opening of the video, showing that there was unanimous buying across all asset classes. So that is why we see big pockets of green here. Notably, I want to shift gears here to the biggest blocks, notably Apple, Microsoft, Amazon, Tesla, and Nvidia, right? Double digits for Nvidia, double digits for Tesla, 7% for Amazon, 8% for Microsoft, and 8% for Apple. Remembering that Amazon will be splitting on Friday, so I'll be paying close attention to the price action there. And then as we zoom out to the year-to-date performance, now what's really interesting is that Apple has exited bear market territory. Why? It's now down less than 20%. Microsoft also out at negative 19. Google still in, Amazon still in, Tesla still in, Nvidia still in. However, the two biggest companies in the entire stock market are Apple and Microsoft, and those ones are out of the bear market territory. So are they now the new leaders? Are they still the leaders? And if so, they have to drag Google, Tesla, Amazon, and Nvidia out of bear market territory. Otherwise, we're going to be paying attention to Apple re-entering negative 20 and Microsoft re-entering negative 20. All right, so with all that said, now let's look at some charts. And hopefully you guys are going to enjoy this. Let's try to go through and just try to make sense of what is happening. All right, I want to start here by looking at a couple of things that are going to give us some big clues. Here we're going to be looking at the dollar, and it's down by 1.3% on the week. It's much closer to 100 now than it is to 105, which would be a bull break. So this is positive. We do still have a W pattern, which is usually going to be a winning pattern, means more up. And we got a golden cross, which means that the dollar wants to continue to go higher. If this is more than just a back test, we're going to lose 100, and I'll be watching closely for that this week. The VIX, it's actually starting to break down again. It's now below 30. It's now back into the mid-20s, and that's constructive. Is it enough? I don't know. I'm looking at TNX, or the 10-year Treasury note. Again, we did we triple top, right? 1, 2, 3 tops. So usually for us to break bullish, we get a third test, and that leads to the rally higher. So we've had 3 tests, and it ultimately rejected. We were not able to hold this yellow pocket here where there is supply. And this is important because the 10-year note is going to be adding pressure or giving a lift to tech stocks. So the fact that it's now down by 3 weeks in a row and much closer to that 2.4% the CBO was projecting, it means that we're now down by 10% off the highs. And people are choosing not to buy 10-year notes, which is bullish. All right, now in terms of oil, this is not looking so good. Why? Well, again, we're going into the summer when there's going to be a higher demand for energy, and it had a big up week. It's up by 4.3%. We note here that there's all these lower tails, which means dip buying, and we also note that we're still in a cup and handle pattern. So a cup and handle pattern after it's already been mooning is not really all that great, right? We see the cup here, even if it back tested, that could be the handle before ultimately going higher. So we can also note the volume's dropping off, but the price action's strong. So just watching for clues here. This is also going to be a preview for inflation. Why? Energy is used in everything. Transportation, it's used in, right, everything. So if oil continues to go higher, we have to pay attention to it. Now having a look here at crypto, what's important about crypto is that it actually printed a weekly lower low. So we're not seeing broad-based, we saw broad-based risk on in terms of all asset classes except for crypto. So the question for me is, are people choosing to rotate out of crypto into things like ARK, into things like the Russell, into things like SPY and the NASDAQ? And is that the reason why we're not holding up here? Or is it because we're getting a preview for what's going to come next? Again, I encourage you to drop me a comment and let me know what you think. So the warning here is just that we're hovering at the low of the week and does not look good. Why? We're right on the green line, which should be a demand pocket. And again, a demand pocket means that when we come down into it, they buy it. 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 Why are they not buying it now? We're actually hovering at the low. We're below 30K. And that same thing is happening here on ETH. We're actually quite a bit below last week's low, more than $100. So hanging out at the bottom of the buy pocket again. Buy, and stalling. Doesn't really impress me. Again, is crypto just losing favor, meaning that people prefer to buy other things like gold? And again, gold had an up week. So is this normal? Is this what we expect? I don't know. All right, now let's look at these trillion-dollar companies. Actually, I'm going to look at ETFs first, then we'll come back and look at the trillion-dollar companies. So here we got the Dow. Dow had an incredible week, 6.3%. And what's notable here is that it actually bounced off of our, didn't even quite make it to the 2020 highs. It made it only to the 2021 lows and bounced off. It's technically still a massive M, right? Still a massive M here inside of a head and shoulders pattern. So if it's going to lead to more downside, I don't know, but this looks incredible. And as we go through and look at the rest of the charts here, I just want you to note how close to the high of the week we are. Why? Well, because as we were going lower, what we talked about is that pressure was building up. As we close at the low of the week, pressure builds up, it builds up, it builds up, it builds up until what? Until it gets released. That's the release right here. So pressure got released, and if now the Dow is building pressure to the upside, it should lead to immediate continuation. Immediate, meaning on the first day next week on Tuesday, we should see snap. We should go higher. It should be bouncing. XLK, again, a little bit different than QQQ because of the weighting, but it's actually much closer to resistance than support. Why? There's less of a weighting on Amazon and Tesla inside of XLK, which is managed by Spider. Again, the same one we look at for all the other ones, XL, XLF, XLE, XLU, XLF, whatever. So here, technology might be a little bit stronger than we think by looking just at QQQ. So again, nice snapback. Is it enough? I don't know. It's a really nice start, also at the high of the week. So at the high of the week on resistance, if we're going to advance higher, again, should be happening first thing on Tuesday. The Russell, yeah, look at the Russell go. So again, we bounced off of the 2018 and 2020 highs, and that is where we're currently finding that base of support. Incredible week 2, up by 6.5%. And we're right near that critical low at about 187. So if you know what 187 means, are we going to do a 187 to the bulls or to the bears? Drop me a comment and let me know what you think. Looking at ARK, okay. 7% on the week. Oh, that's nice. We definitely see the capitulation volume. Yep. We notice a snapback is starting. We see a hammer. It's at the high of the week. It's going to break the downtrend. Where should we be going? We should be going to this current arrow right here, which points to 52. Again, if we're repeating the psychology chart, that is where we should be stalling out before beginning the frustration and anger period. So if we can get above 52, that would mean for me that the riskiest assets, which are down the most, are not just dead cat bouncing, they're attempting a reversal. So again, getting above 52 means that we're trying to start going back up higher. And we still have to break our downtrend. There's lots of work we got to do on this chart, but I'm seeing some positive signs. And then as we look forward to the NYSE, or the New York Stock Exchange Composite, again, it includes 2,000, I think it's actually 3,000 stocks, I forget. We notice that it's a little bit of a different pattern, but we're inside of a pocket right here. And we note that we've already taken out the relative low. So the broader market is stronger than the S&P, and it is also stronger than the SP 500. That's really interesting. So now what we want to look at is where should we find some resistance? Well, it's not that big of a stretch for us to get to our 50 weekly moving average here. So it might be the first one to actually make it back there. I'll be paying very close attention to it. All right, now let's look at these trillion-dollar companies and see whether or not Apple and Microsoft exiting bear market territory is enough. All right, so now we're going to go here to just looking back to what happened since 2020, and Apple looks pretty good. Almost engulfing the, almost taking out the high from last week. So again, closing out at the high of the week should lead to immediate continuation. How much higher? It's pretty close to that 50 MA. It's only off by about $7. Watching really close to it. Why? Again, it's also roughly a head and shoulders neckline. So watching really, really close. Can Apple lead us higher? All right, let's watch. I'm looking at Microsoft. Again, still technically in a falling wedge, but again, there's room for interpretation. We could even adjust this to make it look a little bit closer to the other ones where it's breakout. I'm still saying that it's right here. So looking for leadership, still in a bear pattern. And if we're able to break out of here, I think we can go up to that 50 MA as well. Closing at the high of the week means that pressure is building up and should release into Tuesday. We're going through these stocks in order of market cap too. So when we look here again, I'm just going through these one by one in terms of their size or weighting to the S&P 500, if you're not sure what I'm doing. So looking back here to Google, again, Google looks pretty good. It's pretty close to a breakout. It's got some bull volume coming in. Is it bigger than the red bar? No. They do have a buyback happening though. So is this Google buying back their shares, or is this investors actually dipping their toes in? We don't know, but it doesn't really matter because the chart's going up. So hammer here, again, at the high of the week, if it can just open up flat, it'll break the downtrend. And then it's got a lot more room to go up to its 50 MA here at about 27.12. So there's still a lot more room for Google to go higher. And Google should do well if travel is going to be picking up, which is what we're hearing across the board. People want to travel. They want to get out of their houses. So Google should benefit because they do a lot of travel ads. Looking at Amazon, again, that split is coming in on Friday. And what did we do? Well, we exited the buy pocket area. So we're now out of the buy pocket, which means if we're going to squeeze higher, we should be looking for a test up here to that 200 weekly moving average. And then how we react to it will be a big clue. If we can get over it, that's nice. If we can't, that's not nice. And remembering that we have a big gap starting at about 2,700. So if we're starting a short-term W here, I'll be looking for it to get to the gap zone at about 2,600 and then watch for the reaction. Why? We don't know what the reaction is going to be. If it's going to be bullish, we'll find out right there. So where is that 2,600 area also align with? Roughly the 200 weekly, which will curl up a little bit more. And it's currently at about 2,550. So again, watching 2,600 really close for Amazon, and specifically the price action on Friday when we get that split. All right, Tesla. It looked pretty bad during the week, but it's crazy what a couple of days can do. Incredible snapback. Tesla is up by 14.42%. Elon Musk would be proud. We got a 42 in there. He would love this. And we can note that it's almost engulfed the entire previous bar. We got a lower low, and just a micro lower high. Closing at the high of the week is also a check like everything else that we see, which means it is wanting to go higher. If it's going to do it, it should happen first thing on Tuesday. So every single one of the ETFs, every single one of these trillion-dollar companies so far is saying that I'm ready for more. All right, Facebook, right? Face stinky. It's green, but only by about 0.82, and actually closing a little bit lower than it opened. Opened at 195.19 and closing at 195.13. So pretty much unchanged on the week, which means that I don't really believe what's happening here. We did hear some commentary from Mark Zuckerberg this week as well, saying that the metaverse is going to lose a lot of money for how long? For years. So it kind of makes sense that Facebook is not really rallying, and it's stuck inside its pocket right here of roughly 220 down to 160. So I want to see a decisive break higher out of 220 and then confirming by getting above the 200 weekly moving average if Facebook is truly still bullish. Finally, closing it out with Nvidia, which had a decent earnings report, but then guided down, and it didn't really impact the stock. As we note here on the volume, which is the first thing that sticks out to me, it's increasing. And the biggest bar is actually a green one, which is the most recent one. So if we're going to get increasing price, increasing volume, that would be very nice because we're bouncing off the area from 2021, which is where we're carving out that current low. We've now broken our falling wedge, and we're trying to go back up. And the 50 MA would be the target for me. After we get through roughly 208, the 50 MA is here at about 234. So if Nvidia is a leader, let's see it snap back with Tesla and the others. I don't think there's anything else for me to review. So with that said, if you've enjoyed the video, I would really appreciate a thumbs up. And if you're curious on how we got the follow through from last week, meaning how did we expect we were going to get a bounce on SPY and on the NASDAQ and all the major indexes, and how we were going to break this falling wedge, the video will queue up here in a moment, which walks you through last weekend's video where I explain all my thoughts. With that said, I wish you a terrific long weekend, and I look forward to seeing you next week. Thank you.